The information presented is for educational and informational purposes only and does not constitute financial, investment, legal, or tax advice. We do not solicit or recommend the purchase or sale of any security. Always do your own research and consider consulting an independent advisor before making investment decisions. Weekly Big Summary, July 28th to August 2nd, 2025, plus Sunday, July 27th. Macro and Central Bank. On Wednesday, the Fed left the target range unchanged at 4.25 to 4.50% and explicitly remained in a data-dependent mode. In the decision, two voters preferred an immediate 25 basis point cut, which indicates that part of the committee is already leaning toward easing. The fresh PCE data show that in June the annual headline is 2.6%, core 2.8%, meaning inflation is still above target but not accelerating. Friday sell-off. Weak labor market, big market turn. According to the BLS, plus 73,000 new jobs were created in July. The unemployment rate is 4.2%, and May-June received a total minus 258,000 downward revision. This is a stall speed type cooling, which abruptly brought Fed cut pricing into the market. Political shock to the numbers. After the report, President Trump dismissed the head of the BLS, Erica McIntyre, with unproven accusations of manipulation. The move raised institutional credibility risk and further dented risk appetite. Tariffs, a new wave across a broad front. On Friday, the package sharpened that sets 35% on Canada, 39% on Switzerland, 20% on Taiwan, extended to dozens of partners, in a 10 to 41% band. The market priced this as a negative growth/price pressure factor. With the EU, a 15% baseline deal was struck on Sunday. Market reaction, yields, gold, dollar, equities. The 2-year U.S. yield fell approximately 27 basis points on Friday, the biggest drop in a year. Pricing cuts. The dollar stalled. Gold jumped nearly plus 2% on safe haven demand. U.S. indices fell. S&P 500 minus 1.6%, NASDAQ minus 2.2%, Dow minus 1.2% on Friday. For the week, the S&P minus 2.36%, the NASDAQ minus 2.17%, the Dow minus 2.92%. Oil. Brent fell to $69.67 per barrel at the close, minus 2.8% day over day, in part on the combination of possible OPEC plus supply increases and weaker U.S. demand prospects. Overall, the week still pulled oil higher due to the previous day's geopolitical/tariff strands. Sunday, big news. EU deal. The week was set up by Sunday's 15% general tariff framework agreed by the US and the EU on most European imports, which temporarily cooled transatlantic tensions. Then Friday's global tariff blitz essentially overrode it. Earnings and single-name stories. Apple. Record fiscal Q3. Revenue $94.04 billion. Up approximately 10% year over year. EPS $1.57. Beat. According to Cook, $1.1 billion tariff costs are coming for the September quarter. Friday close, minus 2.5%, with the broad risk-off drowning out the good numbers. Amazon, strong Q2, but AWS margin down to 32.9% and outlook more cautious, minus 8.3% on Friday. Microsoft, Azure plus 39%, visible AI leverage, record CAPEX path, rally early in the week, minus approximately 1.8% on Friday in the market risk-off. Meta, Q2, revenue $47.52 billion, EPS $7.14 beat, strong guide for Q3, sentiment weight on Friday minus approximately 3.0%. Coinbase, weaker volume/adjusted profit led to a minus 15 to 17% slide the day after the report. Exxon, Q2, adjusted EPS $1.64, beat, buyback/dividends ongoing, stock minus approximately 1.8% intraday. Chevron, Q2, adjusted EPS $1.77, beat, record 3.4 million barrels of oil equivalent per day production, Hess deal closed. Qualcomm, Q3 revenue $10.37 billion, beat, Q4 chip segment guide above consensus, device AI cycle is pulling the story. Also notable movers, Reddit plus 17%, First Solar plus 5.3%, Grainger minus 10%. At Coinbase, trading activity presented a weaker picture which, combined with Friday's risk-off, led to a steep sell-off. For crypto-sensitive idiosyncratic stories, the yield and liquidity narrative is particularly important. Takeaway, on its own, the earnings message showed a more positive surprise ratio, But the trio of labor market cooling plus tariff package plus institutional risk trumped everything. The macro overrode the single-name stories. There has been no change in strategy. The portfolio continues to consist of semiconductor manufacturers' stocks. It took a hit on Friday, but I wouldn't call the position bad. Indeed, compared with the S&P 500, it is doing very well. So let's see how the three strategies have evolved. Strategy 1. Lump sum, one-time investment. The first investor bought an S&P 500 ETF on January 2, 2025, investing the entire $15,000 at once. They've held the position ever since. No additions, no withdrawals. Current performance year-to-date, 6.05%. The blue line reflects this result, based on the most recent Friday closing price. Strategy 2, dollar cost averaging, gradual investment. The second investor splits the $15,000 into 12 equal parts, investing $1,250 on the second trading day of each month into the same S&P 500 ETF. This approach helps smooth out volatility and reduces the risk of poor entry timing. Current performance year-to-date, 6.65%. The green line reflects this strategy, slightly outperforming the lump sum method so far. Strategy 3, my fictional portfolio. This portfolio is based on my own stock picks and investment decisions. It launched on March 19, 2025, with the full $15,000 invested in various individual stocks over multiple transactions. I've explained my choices in earlier videos. Current performance year-to-date, 30.48%. Note, these performance metrics exclude broker fees and taxes. They reflect only market-based price movements. Thank you for joining us on this economic journey with Test Portfolio XSX. If you enjoyed this weekly recap of the key events and our portfolio's performance, give it a like, subscribe, and join us again next week as we review the latest market moves and the progress of our investments. Disclaimer. This video does not constitute financial advice and does not recommend the purchase or sale of any financial instruments. I do not take responsibility for any potential inaccuracies or errors that may occur.